Hi, welcome to this video today, which is all about getting started in the Forex markets and learning how to put together a strategy that will help you make consistent profits. Now, if you're a beginner, there's a lot you can learn from one of the most famous trading experiments of all time, which is the turtle trading experiment. And we'll go through some tips from the experiment in this video. But for anyone unfamiliar with it, I'll just explain what the experiment was. Now, back in the 1980s, one of the best traders around at the time was called Richard Dennis, and he said he could teach anyone to trade successfully. His business partner, Bill Eckhart, disagreed with him, so Richard Dennis set out to prove his point. Now, in terms of what he did was he gathered 23 people together, no trading experience. They were all of different academic levels of education, and they had different occupations. So, for example, in the group was a security guard, you also had an auditor, computer programmer, etc. Now, with these people, he taught them a trading strategy, and he taught it to them in just 2 weeks. He then gave them money to trade, and they rewarded him with a profit of over $200 million. They were compounding over 100% per annum. So Dennis approved his point. Anyone can learn to be a successful Forex trader. Now, in terms of the turtle trading method, there's plenty of tips you can get from the method and incorporate in your own strategy. There's one in particular, which I think a lot of traders, even traders who've been trading for a while, don't understand, which is what's called a 90-10 rule. Now, in terms of the turtles, they actually made the majority of their profits from just 10% of their trades. And that 90-10 rule still applies today to the top traders. So it's important, if you want to make really great profits in the markets, you maximize that 10%. Now, in terms of the turtle trading method, it will not work in today's markets. The rules are freely available online. We've actually got a PDF on the turtle trading program. You just join our free mailing list to get it. Now, they won't work in today's markets because the volatility has changed, but the basic principles the method is based upon are timeless. Okay. Now, in terms of looking at trading tips from the turtles, we'll do that in just a moment, but I just want to review 3 books very quickly. It just take about 2 minutes, which you should read because they expand on the material in this video. They're all essential trading books, so they will really help you with your trading strategy. So just a quick review of the books, and then we're going to go through all the tips that we think are important from the turtle trading program. Book Way of the Turtle by Curtis Faith, the most successful turtle. There's plenty of books on the turtles. This is the best. Goes through the turtle experiment in a lot of detail, but more importantly, it tells you how to apply the principles of the turtles in today's markets. Okay, I think any trader should go and read this book. It's frequently now in top 10 best books on trading. Now, in terms of the next book, this book is absolutely fantastic in my view. It's another experiment, actually. It's by Leo Freeman Shaw, and what he did was he got 45 fund managers and he gave them 25 million to 150 million each. Then he said they could only invest in their 10 best ideas to make money. Now, the results were, the majority of the trades were lost. The traders who did really, really well in the group were the ones who really leveraged that 90-10 rule. Really great info on how to execute the trades better. It's an easy read as well. Now, in terms of the book here, it says down the bottom, a riveting read for investors of every level. It is. Any trader should go and read this book. Now, last book is Trading Risk, Enhanced Profitability Through Risk Control. Again, this is by Kenneth L. Grant, who's a hedge fund manager. And again, it stresses that 90-10 rule and also gives you great advice on how to do your risk management better to increase your profitability. It's a little bit of a harder read than The Art of Execution, but anyone who's serious about making money should go and read this book as well. Right, now what we're going to do is we're going to go through some tips from the turtles. Right, just going to summarize some points and go through them. Then I'm going to play out with my best quotes from Curtis Faith, which I think are really good. But first, let's go through the points. Simple trading strategies work best. They do. Now, in terms of all traders, they want to complicate their strategy. They have too many inputs, for example, in terms of generating their entry. It's a huge mistake. In terms of generating an entry, you should use 1, 2, maximum of 3 inputs, in our view. In terms of simple trading strategies, I wrote Occam's razor on my page. A lot of great traders make reference to it, actually, including Richard Dennis and Ed Thorpe, one of the greatest traders of all time. He said, until I learnt the logic of Occam's razor, I didn't make any money in the markets. Just do it as a Google search. Simple strategies will be robust. Complicated strategies will just break down, okay? Now, in terms of fatal beginner's error, it's to do with proving the edge. Most traders take a strategy and they don't research how the edge works, okay? Now, what I mean by this is, I'll give you an example. Let's take a huge amount of beginners who come in and trade pattern trading strategies. Okay, you've seen them, all peaks and troughs and ratios going backwards, really complicated, and the pattern is supposed to repeat forward. Why do traders trade those patterns? They don't work. Just all you got to do is do a simple computer test. Whatever strategy it is, you've got to prove the edge. Dennis knew that if you just gave the rules of his strategy to his pupils, they're not going to follow them, okay? They need to know how and why the edge will work longer term. So he went into great detail on this subject. It's extremely important. Whatever strategy you use, prove the edge to yourself. Then you'll have confidence. And what will that lead to? It will lead to discipline and consistency of applying the edge. Now, in terms of most traders, as soon as they hit drawdowns, flat periods, they get frustrated. They want to tweak their strategy, change the rules. If you do that, you don't have an edge anymore, okay? You must apply the edge with consistency. Time and effort kept to a minimum. Too many traders want to work too hard. The turtles were really just focused on the close of the day. That was it. Now, a lot of great traders say, don't make too much effort. George Soros said good trading is really boring. You're not doing much most of the time. Warren Buffett says he spends most of his day reading books, not trading. A lot of traders, there is that sort of temptation to want to spend too much time and effort, for example, sitting on a screen, scalping and day trading. Well, that won't work. You're just trading market noise, or always checking their positions. Well, if you've got your trade entry in and your stop in, why are you looking at the price all the time? Okay. Once a day was what the turtles did, and that works well. What was their entry? Just using a simple 50, 25-day breakout to a new chart high or new chart low. That will not work today because the volatility in the markets has dropped, okay? But simple breakout methods of big levels do work. We've done plenty of videos on breakout trading, okay? Now, position sizing. The turtles basically took into account the volatility of the underlying instrument they were trading, okay, using the N equation, which is quite advanced for the time. Today, you've got average true range and Bollinger Bands as volatility indicators. What you need to do, and there's a big difference in volatility between pairs, for example, you've got to work out the volatility of that pair and then place your stop outside the market noise, which will still give you good protection. That's one of the keys to making money in longer term. Now, in terms of doing this, Again, we've got plenty of videos online, but it's very, very important. Also, in terms of position sizing, you do not need big size to make money in the Forex markets. The turtles would normally trade 1% risk. You do not need to take big size. If your size is too big, you'll basically increase your chances of risk of ruin. Okay. Now, in terms of maximum exposure, everything goes wrong. 5% is enough. Yeah, maybe a maximum of 10%. Once you get above that level, your chance of ruin are high. Okay, so there's the turtles. Yeah, small trade size, and they're very focused on volatility in terms of getting their stop placed correctly. Now, in terms of their stops, psychologically difficult. What do I mean by that? Well, turtles made references. They knew they needed to do it, but yeah, the stops were uncomfortable because they moved them slowly. Okay, and very often, an open profit would disappear, and they'd end up with a loss. Also, when a trend developed, they would give back profits at the end of the trend. In terms of Forex traders, a major problem is traders are too keen to protect themselves against loss. So they put their stops too close, okay, within the noise or at an obvious level where other traders got their stops and they'll get picked off. Or they'll try and move their stop to break even as quickly as possible. That is a really fatal error, okay? Moving a stop to break even, or traders say, well, got a free trade now. No, you don't, because if you get stopped out and the market continues the way you thought, you've missed out on a great trading opportunity. Yeah, great traders know that they have to use a reasonable distance to stop, but if you're using small size, that's fine. They know that a lot of trades in profit will come back to losers, okay? But you have to do that to catch the big winners, okay? Now, in terms of understanding flat periods, drawdown, and profit bursts, turtles had long flat periods of drawdown, many months, okay? But when they had profits, they had huge profits. A lot of traders don't understand that most of the time you'll tend to find that you're making minor profits, minor losses. You're not going to be, getting consistent profits month on month on month. Okay, it's not the way it works. Most great traders will tell you that, they will have drawdowns or flat periods of 3 months or more, maybe. Every trader who trades long enough will have a flat period or drawdown period of 6 months. Okay, you've got to focus on the long term. You tend to find that the big profits come in a minority of months in the year. Okay, the turtles found it's just a few months per year that they made the really big gains. Other times they're flat or in drawdown. Okay, now 90-10 rule. All top traders harness 90-10 rule. It's not just about patience. A lot of traders might be thinking, well, if I'm patient, just wait for the best opportunities, I'm going to get a lot of winners. Okay, no. Even if you're patient, and you should only be trading within the parameters of your strategy. Okay, that 90-10 rule will still apply. Ken Grant did a big study on it. All the great traders, this applies to like George Soros, Ray Dalio, obviously the turtles. The 10% gave them their big winners. But I think if you embrace the rule, okay, 90% of your trades are going to be minor profits or losses, doesn't matter. Okay, you are going to have months of drawdown or flat periods, but you're not going to lose much because your trade size won't be too big. And then you can just wait for the edge to kick in and give you the big winners. It makes trading, in my view, stress-free once you embrace that 90-10 rule. Okay. Now, in terms of trading the turtle principles in today's markets, markets have obviously changed. The volatility is a lot lower than in the 80s. So, 50 and 25 day simple breakouts will not work, in my view. But you can still do breakouts of big levels. Okay, done plenty of videos on how to do this, and I think from the turtles you can really learn about risk control, that N equation, for example. I've only given a brief summary of it here, but you should go and look into it in more detail, get our free PDF. The way they did position sizing, the way they took into account volatility in terms of placing stops and managing stops, you can learn a lot from their money management. Okay. Now, in terms of today's markets, we still do have big trends. There's more noise within the trends. So I think, yeah, you can have a very simple technical trading strategy, but add in a sentiment indicator. If you know where the big money is sitting, you can measure how far a trend might go. We've done plenty of videos on how to use sentiment. You can check out our weekly forecasts as well. Now, in terms of the turtle trading program, I learned about it in the late 80s, and the rules were not revealed then. And I was really puzzled at how they made so much money. Now, of course, the rules are public. Yeah, a simple system which you trade with an edge you're confident in, and you trade it consistently, will make you money. Okay. Now, in terms of the video, I think I've made all the points I need to. Just going to finish off with quotes from Curtis Faith, which I think are really good. Thanks for watching the video. Take care and have a good day.